David Nicholas with me now. Look, David, we've got day 2 of Powell's testimony this morning, jobs report Friday, CPI next week. This is a risky market to be buying into right now, isn't it?
Yeah, Stuart, you're right. I cannot overestimate how important this week is, right? We have the big jobs report Friday, like you mentioned. And look, good news for the economy and good news on jobs is bad news for the Federal Reserve. We're really in a lose-lose scenario here, because if we get a print, and this is what I'm watching, higher than 200,000 jobs on Friday, I think we see 50 basis points. And what is just so frustrating right now, and I agree with Lauren and you on this, is you've got Jay Powell. He's got flip-flops on, he's got a shovel in his hand, and he just keeps digging this hole deeper and deeper. Because if they go 50 basis points, which I think they should, that just erases all forward policy guidance that we've had up until this point. So it's really a lose-lose when it comes to the Fed, Stuart.
Isn't this the classic scenario where if you've got fresh money, you don't put it into stocks because of all the risk, you put it into bonds because you can get a 4 or 5% return guaranteed?
You know, you were the pioneer on this, Stuart. I think you were early on this bond trade before anyone else. So I credit you for this, but you are right. But here's what I would tell our viewers. You got to be careful. There's 2 things that matter when you're looking at bonds. It's the duration and it's the quality. So just take AGG, which is one of the most popular bond funds. It's an investment grade bond fund, but it's got a 9-year average maturity. I like a shorter term on the bond curve. So you can look at a fund like FIAX, which is our treasury fund. It's got an average duration of 1 year. And I'll tell you why that makes sense, because Lauren just mentioned it. We've had a few other people talk about how the terminal rate is probably going higher, above 5%. If rates go higher, you can still lose money on bonds, which is why you want to stay on the short end of the curve. Also, quality matters. I like treasuries here, Stuart, even though we have a debacle coming out of D.C. with spending and debt, which is just insane. Government bonds are still the safest bonds you can buy, so we like treasuries over investment-grade bonds here.
Got it. David, thank you very much for being with us this morning. See you again real soon.